Nvidia is up 262% over the last 12 months on an incredible run. However, on Friday it was down over 5%. So is it still too late to invest in this company, which has been on an incredible run, with analysts giving it some insane price targets for the next 12 months? We're going to take a look. We're going to have a quick update on the numbers, top line revenue as well as bottom line net income. We'll have a quick look at the health, cash versus total debt for those that missed that information. And we'll refresh our look on the Mag 7 performance, Nvidia versus the other 6. We'll also discuss a little bit on the dividend safety, although it is a very small part of Nvidia's return. And we'll also refresh the free cash flow per share, as this will form our updated valuation of the company. We'll see if the institutions are still buying this company over the last few weeks, given that small dip. And we'll take a look at this latest article, which does take a look at some Nvidia board members who are cashing in on the stock after the 2 trillion company has a 27% very strong run up in just the last few weeks. We'll also look in detail at who these directors are that have been selling, when they've been selling, and exactly what price they've been selling. We'll take a look at what this essentially means with a stock split looking near for Nvidia after their incredible rally. And we'll see how this performed versus their last stock split, and it is looking very bullish indeed. We're also going to have a quick look at this company. It has sold off over 130 billion just yesterday. And importantly, we want to understand where these bullish long-term targets come from, with generative AI to become a 1.3 trillion market by 2023, with some estimations for the future. And a quick update for those that missed their numbers coming out from their latest report. Now, in today's episode, we are going to run them through the valuation model. What we're going to take a look at today is we're going to do a 3-tiered look: a low growth rate forward looking, a medium, and a high, just to gain some expectations of how they could perform over the next year. Now, let's take a look at this company's performance. As we mentioned, down 5% on Friday, which erased around 130 billion off their market cap. However, they are still very strong over the last 12 months. In fact, still near their 52-week high. Now, their yield is very small, 0.02%, and their forward PE sits at around 35.6. Again, this is up over 20,000% over the last 10 years, so absolutely incredible, with a lot of analysts still believing there is a lot more to run with this company, which we are going to dive into. So for those that did miss their latest earnings, we can have a quick refresher. Their numbers increased dramatically from FY23, 27 billion to 61 billion, so some very rapid growth. Not only has their top line been increasing, in fact, over the last 5 years, but what we have noted, their operating margin has gone from 34% to 61% in FY24. So their operational efficiency is improving significantly. And one of the biggest drivers for this large increase in their revenue over the last few years, as we can see, was exactly their data center, coming in at 40% in FY21. FY24 78%. So this was one of the huge drivers which they believe will continue to increase their top line for a significant number of years. Now, if you missed their revenues, as we mentioned, 11 billion in Jan 2020, and whilst for normal companies on this channel we're looking at that 3 to 7% level, for rapid technological companies we are expecting a significant increase, and we can see Nvidia has gone from around 11 billion to 61 billion, increasing it by nearly 6 times over the last 6 years. And on a more granular level, what we see is an increase pretty much all the way to 2022 before remaining flat, and then that very strong increase, as we mentioned, into the more recent period. Now, when we look at their bottom line net income, again, a very similar story with rapid growth, 10 times increase from around 2.8 billion in 2020 to just under 30 billion in 2024. And although we do note some inconsistencies, increases to 2022, whilst we saw the drop in 2023, a massive increase into their 2024 numbers. So it is looking very positive over the last 5 years when we have that time horizon. Now, very quickly, their balance sheet does look very strong as well. Their total cash and short-term investments went from 11 billion to 26 billion. And what we can see when looking at their total debt numerically and directionally, it has gone from around 2.6 billion to 11 billion. So we'll look at the metrics, but no real red flag indicators from this balance sheet review. And for those that like to see a comparison against the others in the Mag 7, we can see over the last 12 months, Nvidia with a very strong performance even after the slight pullback, 262%. So looking very, very strong. We do see Meta coming in the second best at 174. And when we extend this over the last 5 years, again, incredible performance, 2,240%, absolutely blowing all of the other companies out of the park. With when we extend to the last 5 years, Tesla then becomes the second best, 826%. Always important to remember, though, that past performance is not an indicator of future. So again, something to bear in mind, even though they have had an incredible performance over the last 5 years. Now, what we did know is that the Nvidia board members did cash in on some of this stock after it has had an incredible run-up, which feels like every day this stock is continuing to increase day after day, other than Friday where we did see that pullback for the first time in quite some time. So when we run it through the insider screener, both buys and sells 100 shares over the last month. In fact, what we note over just the last week, we see 3 large sells. We see Director 1, so Mark Stevens, who sold on the 4th of March for around $10 million. We see Tench Coxey, the director, selling around 170 million shares. And then we see the third one around 4 million. So in total, we're talking about just under $200 million worth of sales by insiders. And in fact, over the last month, we have seen sales. When we extend that to the last 2 months, we are seeing a trend here that insiders are continuing to sell shares, given how quickly this has run up. So something just to bear in mind. As we always say, though, insider selling isn't necessarily a bearish signal. They sell for many reasons, personal, financial. It looks like, from what I can see, that directors are seeing this stock has run up very, very quickly and are looking to cash in. But what we can note from this column here is every single time that they have sold, the share price has gone higher. So again, never really take this as a selling signal, but something just to consider. Now, when we take a look at institutional ownership, it is at that 65%. And whilst we do see outflows by the institutions, there are a lot more inflows, significantly 660 billion worth. And what we can see in the latest quarter, Q4, more buying than selling. Q3, we actually see the opposite. And in Q4, we see a lot more buying as well as Q1. So overall, institutions are a lot more bullish on Nvidia. Even in that latest earnings, we do see them buying still, even at these mouth-watering prices. Now, when we take a look at essentially a stock split, it is something that is being considered, and in fact, we do believe that it will happen fairly soon, given how high this price is, as they essentially want to bring more retail investors into this. So let's take a look at the past performance of how this did in the last stock split. So we see they announced a stock split in 2021, a 4-for-1. After that, the share price dropped. Now, that wasn't essentially because the price went down, but because of the stock split, it started trading at the price of around $200. And what we can see since then, the share price has increased. So what you could argue is that is a very bullish signal. As we can see from 2021, there was a period where the share price did go up quite significantly. In 2022, it did come down to just over $100 before going on a very strong run. So something just to consider. Yes, it has surged since the last stock split. It doesn't necessarily mean it will surge again. But all different factors to take into mind. And it is something that I do believe will happen over the next few weeks, if not at least over the next month or two, an announcement of a stock split, given this does look like it is heading to $1,000. Now, just something that is important to note for those is the first time that they're hearing about stock split or something they don't understand. They are essentially a fully cosmetic move, and this is essentially entitled to attract smaller retail investors. All this does is essentially reduces the share price by redistributing the amount of equity over a large number of stock, and it changes nothing about the underlying fundamentals or even the valuation. So do bear that in mind. It has no effect on the actual amount of shares or in fact the amount of equity that you hold. It is still the same. The number of shares, however, will increase. So if, for example, it goes to $1,000 and it's a 4-for-1 stock split, you will own now 4 shares instead of 1. So again, just something to understand. But what we can see here, the reason why stock splits are attractive, why the share price does go up after these stock splits, is all due to the investor psychology. People would rather buy something for $30 rather than $300. Again, it doesn't really change the underlying asset that you hold. The stock split 4-to-1. For every 1 share you get, you now have 4. Now, when we take a look at this, generative AI to become a 1.3 trillion market by 2032. Now, this is a very bullish signal for the likes of Nvidia, where people may believe the growth will start to slow down after the incredible run it has been on just over the last year. They essentially believe a CAGR of 42% over the next 10 years. Absolutely incredible. And what this effectively means, that AI products could add around 280 billion of new software revenue. Now, when we take a quick look at the essential graph, we can see in 2023 sitting around 67 billion for generative AI revenue. They believe this 1.3 trillion in 2032. This is something that Nvidia can maximize, can really help increase their top line if companies do start to use a lot more of their products, which seems to be the way the world is heading. AI seems to be something, whilst not relatively new, something that a lot more companies are taking seriously, and this could massively benefit Nvidia and their shareholders. So in terms of the financial metrics, we can take a quick look. Dividend safety score 89, very safe. Market cap now 2.15 trillion. It is a mega cap company. In terms of the recessionary metrics, well, they had no dividends, so no comparative data. Below average growth, negative 35% versus the S&P's negative 12. They also trailed the S&P negative 78, while the S&P had a negative 55% return. In terms of dividend growth, well, they haven't increased this dividend since 2018, although we do note over the last 10 years, it has increased by around 8% on average year on year. Therefore, they have 0 years of consecutive increases, but they have 11 years of paying a dividend without a reduction. Now, normally we would look at dividend yield theory, however, it isn't something really applicable given the fact that this yield is very small in comparison to the company's total return. In terms of the forward PE, though, we do note it is sitting lower than the 5-year average, 36.9 versus 41.3. And when we do compare it to the sector PE, information technology is sitting much lower at 26.5. So in terms of free cash flow, again, really not relevant, but we can say it just for transparency and continuity from our other reviews. 1% in 2024, expected next year at 1% as well. So in reality, if they wanted to, they could really increase that dividend, but it isn't a massive part of their essential forward-looking analysis. Now, in terms of the free cash flow per share, it has increased rapidly, 36 cents in 2015, $10.90 in 2024, expected to nearly double in 2025, so a 100% growth to their free cash flow in 2025. Bear that in mind. We're going to take a look at that when we look at our valuation shortly. And what we can see, their sales growth, we did mention that, but percentage-wise, incredible 3-digit increase in 2024. We can see before then even a lot of years where they had double-digit increase to their top line. And numerically, it's gone from 5 billion in 2015 to 61 in 2024, and the revenue doesn't look like it's going to slow down. Shares outstanding, they've also issued shares over the last 10 years, so your position would be a net dilution over this period, but bear in mind when the share price has increased that rapidly, you probably wouldn't care about this share dilution. ROIC, absolutely phenomenal. As always, we want to see 10% as a minimum. So what we can see here has been above that every single year. 61% in 2024, so absolutely incredible. Operating margin, free cash flow. Well, on the operating side, as we mentioned earlier, the operating efficiency has increased over the last 10 years, going from 16% in 2015 to 54% in 2024. And the same could be argued for the free cash flow margin. 45% in 2024 is a very, very strong metric for Nvidia and the semiconductor industry. Finally, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. This essentially shows us that it would take them not even 1 day to pay off all of their debt net of cash on hand every single year from 2015 to 2024 and expected in 2025. So their balance sheet is incredibly strong and their dividend safety looks to be very safe. No issues with something that is only a 1% of their free cash flow. So let's jump into the valuation of Nvidia. But before we do, just to let you know, we have released our free weekly article. If you want to gain access to this or any other of these articles, all completely free, click on that pinned comment below and you'll have instant access. So typically on the channel, what we do is we get to the intrinsic value by getting to 4 different models. However, on today's episode, the only one relevant is the DCF model. As we mentioned, we do have these other models, but we believe Nvidia is only appropriate to use this model. So we have the discounted cash flow year on year. We have the average growth rate at 30%. Now, forward looking, we have gone for 55%, Based on this, we get the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we get our intrinsic value of $893 with our sign of undervaluation. Now, bear in mind, Nvidia are looking for around 100% increase to their free cash flow. That is what they expect next year. And what we have noted with Nvidia is they have always beaten those targets. So again, they could be higher than 100% in 2025, something just to consider. Now, we have three different targets here. We have a low, medium, and high, which we're about to use to get to the different upsides. In today's episode, we have gone for what we believe to be the lower target at 55. If we were to move on to the medium at 60%, this would essentially give us the intrinsic value of $1,176. And if we move this to the high target of 65%, as you can see here, this would give an intrinsic value of $1,539. So we have the different growth rates, the low, medium, and high. We have the values, we have the upsides. These are all incorporating to the fact that they expect 100% free cash flow next year. We're looking at an AI essential industry of 1.3 trillion into 2032 and beyond. So a lot of different things just to factor in. And again, analysts are increasing their targets every single week with the share price increasing. So always take that with a pinch of salt. But essentially for this company to get to that 1,500 value, it would need to have estimated free cash flow of 65% growth every single year and beyond. So again, it really does depend. You could argue these are very high, or you could argue these are low depending on your investment thesis. If you do grab a copy of this model in the pinned comment below, you can run your own company in this model, you can run company in your watch list, or you can go through Nvidia based on your own estimating. So for today's episode, we are looking at an estimated lower growth rate of 55%. So to get to the intrinsic value, it is 89268. So what we typically do is use our margin of safety of 10% as what we start with, and we use that if we believe it has a wide moat, strong financial metrics, good forward-looking data. If you believe that with Nvidia, then a buy might be around $800. If you were looking at around 15%, around $759, and if you're looking around 20%, around $714. Now in today's episode, we can see it has around a 5 to 10% margin of safety. And again, it will be interesting to hear your thoughts below, whether or not you believe this is still a buy after the 5 to 6% pullback that we saw on Friday, and your thoughts going forwards. In terms of Wall Street and their forecasts over the next 12 months, well, we have different price targets. So we have gone for the average of around 1,000. So they still see around 22% upside to the current trading price. As always, let me know your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button. And as always, we'll see you on the next one.